Right, we are absolutely on time. It is 9:30 here on the West Coast. One of the questions actually came up, where are you guys at? Well, we're all over the place. I am here on the West Coast of California. Dave is on the East Coast. He's out in Jersey. Rick is down in the Atlanta area, and then we've got Steve in Chicago, and then we've got Brittany in Atlanta, and we've got Ken in Chicago. So you've got us coming all over the country. This is Sean Howell, and I got the next session. And Dave did such a great job of kind of building that foundation that I'm going to build on that foundation, and he really did a good job. So great job, Dave. I hope you all enjoyed it. We'll, of course, look at the surveys and see what you thought, incorporate any suggestions. My heavy lift right now is I got to get you to the idea of buying calls for a rising market. As Dave was saying, call options, buying them are usually the first natural step because it's kind of intuitive and it follows the mindset of buy low, sell high with stocks. That doesn't mean that you're not going to end up selling calls as you hear about call options from Ken in the next session, or you end up buying puts for protection or buying puts for speculation. This is just sort of the natural flow when it comes to how we deliver the content, how people's minds tend to work, so we can play off of that. Now, the question that we often get is going to be, well, what's the best call option for me to buy? That is what I'm trying to answer in this session. There's not a best. Everything that we have to balance out is going to be risk, reward, and probability. So I'll be talking about that in this session. I wanted to leave the disclosures up for a little bit. I have taken screenshots of a real live stock. It kind of doesn't matter what the stock is. Maybe I'll talk a little bit about the stock. It doesn't really matter. The idea is I'm bullish. I think something's going up. I want to utilize a call option for some leverage. How does that look? Which one should I do? Again, I'm going to talk about weighing those out. Now that David kind of laid the foundation, let's do just a quick survey again so we know kind of where you're building, and we'll do this throughout the day. So if you wouldn't mind, please rate your confidence level on this subject, and this subject is specific to buying call options before you attend this. And then, of course, I'll do my best to try to get you a little bit more comfortable as we're going, and see if we can get you to the point that you're either ready to do a paper trade, or you're ready to turn the other way and walk away from options, or you're ready to maybe do a real trade. That is what our objective is to ensure that you have the information to make that decision as far as what is going to be best for you. Okay, so here's my agenda for buying calls for a rising market. I'm going to talk about the anatomy of a rising market. Then I'm going to talk about 4 friends and 4 trades. I'm going to get into scenarios and the potential outcomes. And we'll see if I have time to get into E-Trade's paper trading application. I will be showing Power E-Trade at the end of the day. I've got 30 minutes to do that. Paper trading is the Power E-Trade simulator. So if I don't have the time to get to paper trading, just know that attend the later session or watch the recording of the later session, which will be at etrade.com/bootcamp. or etrade.com/events. You'll find it there. Or if you want the entire breadth of our educational offering, etrade.com/events. All right, that's my rather ambitious goal here for the 50 minutes. Dave's session's a little bit longer because we want to go slow, lay that foundation, and not throw anybody off, but also some housekeeping as well. Okay, generally speaking, I'm a momentum trader, which means that I believe an object in motion tends to stay in motion. So when I see a chart and I look at it and I say, yep, the momentum is to the upside, I would call that a bullish chart. Bulls think the market's going higher. Bears think the market is going lower. So here's kind of the bullish characteristics. Now, I'm talking about me being a momentum trader and that object staying in motion. Plenty of people, plenty of my friends are going to be reversal traders. They think, hey, this stock has found a bottom. It's going to do a V or a pivot and start heading the other direction. They're not trading momentum as much as they're trading reversal patterns. Or if something's been going higher and they think it's going lower, they may buy a put option because they think it's going to reverse. I tend to be a momentum trader. That's just something I've developed over my trading, which has been in options over half of my life. It just kind of feeds my risk tolerance and also how I analyze charts as well. So what are the 5 bullish chart characteristics that I generally look for? Well, I'm looking for higher lows. The lows of the day, day after day, or the lows of the hour, hour after hour, or the lows of the week are getting higher with time, okay? That means to me that the buyers are continuing to accumulate shares. And I believe that the biggest buyers are going to be the institutions. And the institutions are buying for a reason, and they're slowly accumulating shares. So we're seeing the lows day after day in the case of this chart going higher and higher and higher. Okay. Next point that I'm looking for is higher highs. This is a typical textbook description of an uptrend or a bullish uptrend, right? Higher highs and higher lows. So in this chart, I'm seeing higher lows and I'm seeing higher highs. I also like to see that the volume is higher on those up days. Not always, but I want to say, hey, as the stock goes higher, the buyers have enough confidence to not only continue buying at these higher levels, but buying in volume. That's great. That tells me that they're continuing to accumulate and they are comfortable with the current prices. So I like to see higher volume on up days, and I love to see lower volume on down days. Of course, stocks are going to have up days and down days, but on the up days, if the volume exceeds the volume on the down days, to me, that's telling me, hey, there's going to be a continuation, or that momentum to go higher is going to build. That's what I'm looking for. And then kind of the fifth one is the stock is breaking into new price levels. Maybe it's breaking into a 1-week high or a 1-month high or a 3-month high or a 1-year high or an all-time high, but it's breaking into new ground. And if I was looking at put options, just kind of reverse everything. I'd be looking for lower highs, lower lows, higher volume on down days, lower volume on up days, and breaking into new price levels. This is for me, kind of the general setup for a momentum trade to the bull side. Now, let's say that 4 friends are all looking at that chart and they all go, yeah, we think it's going higher. How are they going to trade that? So I've kind of gone through 4 examples, and let me start talking about the 4 friends, the 4 styles, and they're all bulls. Again, I'm using a little bit of stock market vernacular here. All bulls, meaning, yeah, we think it's going higher. How will that manifest in their trade styles? Now, if they're all just stock people, there's not much of a presentation to give here, but they're not. Everyone's different. So let's go through a couple of the personalities. You've got the stock trader. I've abbreviated as TST. And the strategy for the stock trader is, I'm just going to buy shares in the stock. I think it's going higher. Buy low, sell high, all that stuff. Okay, great. We understand the stock trader. Most people get it. It's where most people start. Then we've got the options trader, which I've abbreviated as TOT. And the strategy here is to buy an in-the-money call. I'm going to go through that as well, and I'm going to break that down. That was one of the questions in Dave's session. Why would you be buying an in-the-money option? It looks like it costs more money. Why would someone do that? Great question. I hope to answer that in this. The third one is Ms. Extra Leverage, abbreviated as MEL. So Ms. Extra Leverage, the strategy is to buy more at the money calls. The in the money calls cost more money. The at the money calls cost less money. So her strategy is going to buy more of them because they're cheaper. Now, there's always going to be a gain and a give up, and that's what I'm going to be talking about as I start to compare all of these against each other. And then Mr. Go Big, MGB, you could probably already guess, the strategy here is to buy even more out the money, abbreviated OTM calls, because those are cheaper. So Mr. Go Big can buy more of them, giving Mr. Go Big even more leverage as well. Okay, let's keep rolling here as we get into it. So I'm going to break down each of the traders. The stock trader says, and I hear this when people ask what I do and what I like to do with my money, and I explain derivatives and options, and I do a little this and do a little that. I hear people, yeah, no, that's not for me. I just buy stocks and leave them in for the long haul, and that's kind of the stock trader here, but not a stock investor, stock trader. So there is still that short-term mindset. No options. Just shares. I have unlimited upside, and I don't have to worry about, it expires in a month, or it expires in 3 months, or 1 year, or 2 years, anything like that. So unlimited upside and no time limits. Now, when we get into what the stock trader is going to do as far as executing his strategy, it's buying 100 shares at the current price, and the current price when I took the screenshot was 154.07, and I was taking real screenshots, so this price was moving around on me. So you may see a couple of pennies here or a couple of pennies there in discrepancies from my screenshots when I start showing them. But this stock trader has bought 100 shares at 154.07. In the upper right-hand corner, the maximum gain when you own shares, unlimited, right? Sky's the limit. Buy that Learjet, buy that island, whatever you want. How much could our stock trader possibly lose? Well, you can't lose more than you put into it, and he's put in 15,407. Obviously, the stock would have to go to zero, which has happened. I will remind everyone about Lehman Brothers and things like eToys and the old General Motors. They all went down to zero, so it is possible. Granted, hopefully not something that you'll experience, but the maximum loss is at zero, 15,407. Break even, 154.07, right? Since commissions, for the most part, have gone away. If you were to buy these 100 shares at 154.07, if stock goes up 1 or 2 pennies, hey, you're already making money. It's not always the case with options. We'll be talking about that. And how much time until it expires? Technically, it doesn't, right? So it's not applicable in this case. So here's the order. And by the way, I'm taking the screenshots from the order from Power E-Trade versus eTrade.com. Power E-Trade is free to you. As an option trader, I feel it's better. It's streaming, it's dynamic. I'll be doing a demo on it. I just think it's a better experience. So I'll encourage you, start to get familiar with it, and I'll highlight it later today, and you'll see why I think it's better. Again, it's free. I'm not trying to sell you something that's going to cost you money. I want you to have the best experience and the best data in front of you. So here we've got the stock trader buying 100 shares. Now, on Power E-Trade, we have something called the snapshot analysis. And this is the snapshot analysis before you enter the trade if you just kind of want to understand what you're getting. And you can see it's broken out pretty simply. We've got things like max profit with the green smiley face, infinite. Hey, that's awesome. Maximum loss, 15,407. Great. Break even, 154.07. All good. And if you look to the right, that's called a hockey stick diagram. You can see as the price goes higher of the stock, more green, that means more profit. And as the price goes lower, that means you will lose money all the way down to zero. So that's the hockey stick diagram right there. Okay, that's the stock trader. Let's go and say, or walk through what the options trader says. In the money calls, gives me leverage with less time decay. Do you remember Dave was talking about deltas? So the deltas of this one, you can see it, my buy order kind of outlined in green. You can see the column that says delta, 0.79. The stock trader bought 100 shares of stock. So if the stock goes up $1, the stock trader will make $100, right? It's simple math. If the stock goes down $1, then the stock trader loses $100. Well, what about this option? If the option trader buys one call option and the stock goes up $1, look at the delta, 79.5. The option trader will make about $79.50. If the stock drops $1, then the option trader is going to lose about $79. But look at the cost of this trade. If we go back, you got to remember that the stock trader put in, 15 grand. Look at the cost of this trade, right? The cost to buy one contract, which represents 100 shares, of the April option, with 73 days to go, with the 140 strike price is going to cost about $18.35, 1,835. Now that's the current asking price here. In the upper right-hand corner, let me walk you through so you can do this compare and contrast in your head. Maximum gain, unlimited. Sky's the limit. The most you could lose, 1,805. Wait a minute, Sean, I thought you said 1835 was the ask. Why did you put in 1805? Because while I was taking the screenshots, the price changed, and you'll see in the next screen that I could have executed the order at 1,805. So 1805, you can't lose more when you buy a call option than how much the call option cost you. So you have at risk 1,805. How much does the option trader need to have in his or her account? You need to have $1,805. Sometimes people look at this and they go, oh, the one contract represents 100 shares at 140, so I need to have $14,000 in my account. No, you don't. You need to have 1,805 in your account, plus, in this case, 65 cents in transaction fees or 50 cents. But anyway, I'll keep going. The break even on this is 158.05. Okay, I need to walk you through that, and time to expiration is 73 days. So when you buy a call option, the stock must go up in order for you to be profitable. If it goes sideways, you will be losing money. If it goes down, you'll be losing money. When you buy the shares, if the stock goes up, great, you make money. If the stock goes sideways, well, you don't make money, but you don't lose money. You lose time. And when you have a stock, time doesn't cost you anything. But when you own a call option, time costs you money. That's that theta. How much per day is time costing me? There's 73 days in this option. So every day, the time value is sort of dwindling a little bit. And then again, I use the snapshot analysis, and it looks different. So kind of compare and contrast this. And of course, you can download the slides. But take a look at what we've got here. Maximum profit, infinite, sky's the limit. You can buy that Learjet, buy that island. Maximum loss, 1,805. Maximum loss here is a lot less than the maximum loss of the stock. But then again, this thing only has 73 days of life in it. The stock has, really theoretically unlimited, right? So 1,805, and the break even is 158.05. So it is a requirement that the stock go up in order to be profitable. And I'll show you as I get to the scenarios here as well. So let's go a little bit more aggressive here from the in-the-money option to the at-the-money. So Ms. Extra Leverage says, I trade at-the-money calls. At-the-money calls would be the call options that are closest to the current price of the stock. This is very typical for people just getting started. Doesn't mean it's better. It's just typical because it's, hey, the stock price is about 100. I could buy the 95 call option. I could buy the 90. Or I could buy the 100, or I could buy the 105 or the 110, and I've got examples for all of those here. Okay, so I trade out the money call options for quick leverage moves. Notice I'm saying I trade at the money calls, plural. Our option trader was only buying one because it was kind of expensive, 1,805. Let me walk you through this. The maximum gain on this one, well, I should say, this extra leverage bought 2 contracts. So taking kind of a similar dollar amount, even less money, but buying more contracts gives you extra leverage in this case. So Ms. Extra Leverage bought 2 contracts of the same expiration, the April 2023, 155 calls that were priced at $7.95 each. Since each contract represents 100 shares, one contract costs $795, which means 2 contracts cost $1,590. Our maximum gain in the upper right-hand corner, unlimited. Same with the stocks, same with the option trader. Maximum loss, $1,590. Less money, break even, $162.95. 73 days to go. So let me quickly show you what I'm starting to get at here. Let me go back one slide here, and let me show you. So the options trader, you'll see has a 19.67% probability of maximum loss. So just under 20% probability of losing 1,805. This extra leverage, who has bought 2 of the at-the-money options, if I compare those, 1,590, the maximum loss of 1,590 has a 50% probability. More leverage, less money at risk, higher probability of loss, lower probability of gain. So we're changing things, right? Things are changing. The whole balancing act between risk, reward, and probability is changing. Okay, so I think you understand this extra leverage. Let's go a little bit more aggressive, and let's look at Mr. Go Big. Buy lots of cheap ones. So what are we talking about here? Now we're looking at the 170 strike. Remember, the stock is down at 155. So now we're buying the pretty far out the money options, and just take a look at that option chain for a minute. Looking at the 170 that I've got highlighted with the green box. Look at the delta, 0.21. This means that if the stock goes up $1, this option only moves 21 cents, or this contract moves $21. So the idea behind Mr. Go Big is to buy a lot of them, right? Because they're cheap, or they're cheaper. Now, Dave and I were chatting about this, and Dave said, you know, usually a Mr. Go Big or a Ms. Go Big, they don't buy something that's $2. They buy something that's 20 cents. And instead of buying 3 or 4 of them, they might buy 10 or 20 of them. You know, really very, very speculative, as we kind of tongue-in-cheek say, like lottery tickets is what they are. But let's keep walking through this one. Buy lots of the cheap options. If you buy lots of the cheap options, you're getting a lot of leverage. But again, you're going to have a very low probability of being successful. But when you are successful, it can be a big gain. Maximum gain, unlimited, same there. Maximum loss, 860. The break even is 172.15. It's more arduous for the stock over 73 days to go from 150 to 172.5. And let's break that down statistically speaking here. Here's my buy order for 4 contracts of the April 2023 170 strike, and I can see the ask is 215. So putting in the order is going to cost $860. Mr. Go Big bought 4 April 23 170 calls at 215. When we look at the hockey stick diagram, look at to the right. Look at how high the dotted line to the left of the hockey stick diagram indicates the current price. Look at how much red there is, and look at where the red turns to green in that hockey stick profile. The stock has to go all the way up there in a 73-day period in order to be profitable. There is a 76% chance that the stock will not be able to move that much in that amount of time, which means when it fails to move that much in that amount of time, there's a 78% chance that you will lose $860. So I'm saying Mr. Go Big is, hey, go big or go home. In this case, I would say, yeah, if it goes big, then you could do very well, but the likelihood is you're probably going to go home. So let's take this. Oh, I see a question about, can you explain break even? Absolutely, Adam. Break even is you take the strike price plus what you paid for the call option, and you add them together. And that means that at expiration, the stock will need to be at that price in order for there to be any money left on the bone at all. So in this case, we take 170, and let me go back. I'll show you what we're doing. We take the strike price of 170 plus what we're paying for it, $2.15, and we add them together, 172.15. So I would say, hey, in 73 days, I need the stock that is at 150 now to be at 172.15 or higher, or I lose money. And anybody that hears that would go, so you need the stock to go from 150 to like 172 in 73 days? Yep. Wow. You really think it's going to be a big mover. It has to be. Whereas if we go back to the options trader, the option trader needed the stock to go up like 4 points in order to hit break even. So there's that balancing act. Okay, let's go through and I'll take the scenarios now that we've kind of got them set up. So we've got the 4 friends doing the 4 trades. Now that we've got the trades on, the market can really only do 3 things. It can go up, it can go down, it can go sideways. We know time is going to move forward. Nothing we can do about the time component, but what happens over the next 73 days. And I want to give you those scenarios so that you can kind of play through, what it would be like and where are you at in this risk spectrum. Okay, scenario 1, stock rises to 170. Okay, that's great. That's exactly what everybody wants. Everybody's bullish, so they want the stock to rise. Okay, stock rises to 170, and everybody has held their option right up to expiration. Okay, conceptually, just stick with me on this. How does that look? I've broken everybody out. So stock is at 170 on the last trading day. Wow, 150 to 170, that's a big move over 70 days. 170 on the last trading days. The stock trader has a nice gain. Let's take a look at those 100 shares. The 100 shares that the stock trader paid $15,407 for is now worth $17,000. There is profit on the table of $1,593. Hey, you're up 10.3%. It's pretty good, right? You got 10% return on the money you put at risk. When I talk about options, I don't usually talk about return on investment because it's not really investment. It's how much you're risking because it has a limited amount of time. So return on risk is 10.3%, but you've got 1,593. Now, the stock trader can hold that position, or he or she can close it out. Let me see here. Hey, you guys all good with the slides I'm showing? Okay, saw some comments there that maybe my slides weren't keeping up. Looks like they are. Okay, so the stock trader's happy. Let's look at the options trader with the one in the money 140 call that he paid $1,835 for. The market value of that is $3,000. The profit on the table is $1,165. So assuming he sells the call option that he bought, or I think Dave said earlier, closes it out. If you buy a call option, you would sell the call option to close the position. If he closes it out, he will walk away with $1,165 profit. That is a 63% return on risk. So look at the stock trader versus the option trader. The stock trader made more money, but he also put $15,000 worth of risk on the line. Hey, 10.3% is pretty good though. The option trader put $1,835, a little bit more than 10% of the risk, and made $1,165. Made less money, but a return of 63%. Okay, that's pretty cool. But look at this extra leverage that bought 2 of the options, the at the money 155s, and only put 1,590 at risk. She's made a profit of 1,410 when she closes the option out or sells the call. She made 88%. So you can see that the more we go up, that the more leverage somebody took, the more they made. But wait a minute, what about Mr. Go Big? Well, Mr. Go Big, as you'll see here from my little slide, option trader and Miss Extra Leverage do better as a percentage, but less overall profit. And then Mr. Go Big, hey, it was close, but not close enough. Because the stock went from 150 to 170. Do you remember the break-even point? The break-even point was 172. So it's not horseshoes, right? We're close, but not close enough. So in this case, it expires worthless. So the question came up during Dave's session. So if something goes up, then everybody makes money. It depends. how aggressive were you, right? So Miss Extra Leverage was more aggressive than the option trader. She made more money and a better percentage, but Mr. Go Big was too aggressive, and it didn't manifest. It didn't come to fruition, and he ended up losing 860. So if we all just bought shares, oh, I bought one share, you bought 10, oh, our friend bought 10,000, then we can all celebrate. Hey, everybody, whoever bought the 10,000 shares should be the one paying for dinner. But when it comes to options, you can see, hey, isn't it great? The stock went from 150 to 170. Well, there's 3 winners in there and 1 loser. That's the difference between it. So when someone says, what is the percentage of people that are making money and losing money? Well, you can see that 3 out of 4. Mr. Go Big lost money, but the person that sold him that option made money. So when Mr. Go Big lost $860, he didn't lose it to us, E-Trade. He didn't lose it to the broker. He lost it to the person that sold him that call option. So in the next session, Ken's coming on, and he's going to talk about selling covered calls. In this case, you are buying a call option where you have rights. And in the other side of it, you would be selling a call option in which you have obligations. Anyway, I don't want to break anyone's brain at this point in time. So that's just scenario 1. Let's go to scenario 2. The stock rises to 160 in the first 10 days. Do you remember Dave said that a high percentage, in fact, I think the percentage is upwards of 60 or 70% of option trades get closed out, or people liquidate them prior to getting to expiration. Well, options are tradable, right? You can trade in and out of these things basically Monday through Friday during the regular trading sessions. Most people close out their options. Most people liquidate them. But the question is, did you liquidate for a profit or did you liquidate for a loss? So in this scenario, we're going to go, the stock rises to 160 in the first 10 days. Okay, how did that work out? Well, the stock's at 160 10 days later. If you look at the stock trader, because the stock went from 150 to 160, stock traders got $593 of profit. You're up 3.8%. But look at the options trader, right? The options trader in this case and Ms. Extra Leverage are doing better because the option has moved up rather quickly and there's still a lot of time left. So the options trader, the market value is $2,148. That's currently a $313 profit, up 17%. And look at Ms. Extra Leverage. The 2 options are worth $1,956. That's a $366 profit on the table, up 23%. And Mr. Go Big is kind of rocking it at this stage with the 4 out the money 170 calls that he paid $860. They're worth $1,236. That's a $376 profit. That's a 43%, almost a 44% return on risk. So he's doing great. Now the question is, do you want to liquidate? At this stage, do you want to stay in? Do you want to put some sort of an automated exit? Or do you want to liquidate? It all depends on what you are predicting happens next. If you predict that it's going to keep going up, you would probably stay in. If you want to put a stop order in, some sort of an automated exit, you can absolutely do that as well. Okay, so in the first 10 days, stock goes from 150 to 160. Everybody's got profit on the table. Now, you'll notice that you could sell the call to close. I'm using an options theoretical pricing model, which we have on both eTrade.com and we have on Power eTrade, where you can do a what-if scenario. So I'm not guessing at these prices, but I am using a calculator with a formula in it to give me an idea. Because there's still, 60 some odd days left with the option? I don't know what 60 days worth of time are worth, because time value is a component of volatility, interest rates, dividends, many different factors. But generally speaking, everybody under this scenario is profitable. What do you want to do with your profit? You want to leave it on the table, hope for more? You want to lock it in and close it out? Mr. Go Big could sell 2 of the contracts, 1 of the contracts, 3, Miss Electric could sell 1. The option trader only has 1. Keep it, sell it. And, of course, the stock trader can do whatever he wants with stock. We get that. Okay, scenario 3. The stock rises. That's great, but then it fell. So the current price is 155 on the last trading day. Okay, so what I'm really suggesting in this is that over the time frame that we had to expiration, the stock went up, nobody did anything, and now we're back down to where we started. I want to show you what happens when the stock doesn't go anywhere. So when the stock doesn't go anywhere, look at the stock trader, 100 shares, paid $15,407, stocks at 155. Hey, time didn't hurt me. In fact, it went up a little bit, so I made $93, right? It's better than a poke in the eye. But the options trader, so the stock trader has a small gain. It did go up some. But the options trader has a little bit of a gain. So the options trader participated a little bit in this case. So hang on. Sorry. Options trader is a small gain. The option trader has an 18% loss because you paid $18.35. So the option still has value. It's still worth $1,500, right? But it's worth $1,500 at expiration, but you paid $1,835. This is where your neighbors and friends would go, hold on, wait a minute. The stock went up and you lost money? How did that happen? Time decay. So the options trader is down $335. That's 18.3%, and the stock went up. Again, I said this when I kicked this off. When you buy a call option, the stock must go up in order for you to make money. Going sideways loses you money, and going down loses you money. And you'll see that with the case of Miss Extra Leverage and Mr. Go Big. Their contracts at expiration are out the money. They have no intrinsic value, no real value, and no remaining time. Option is priced based on intrinsic value, if any, plus time, if any. The Miss Extra Leverage, her 155 calls when the stock is at 155 have no intrinsic value, right? Zero intrinsic value and zero time. Therefore, the option's worth $0. Therefore, she loses $1,590, which is 100% loss. So that would rub anybody wrong. Wait a minute, it went sideways and you lost 100% of your money? Oh, I don't know if I like these, right? First two scenarios, I get it. Third scenario, oh, it needs to go up. Yes. Not only does it need to go up, it needs to go up enough to hit your break-even point. So look at Mr. Go Big. Mr. Go Big's, his 4 contracts are worth 0 too, but he only lost $860 in this case because he was kind of speculating on that, on that edge of where it could possibly go. Okay, 155 and 170 expire worthless in this going sideways situation. So let's take a slightly different one where the stock rises modestly to 157. So I want to take an example where the stock didn't go boom to the upside or quickly boom to the upside, where it just kind of modestly went up, so you can see how this all shakes out. Last trading day, stock closes at 157. Stock trader's up a bit. The options trader has a small loss. So that the options trader with the in-the-money 140 and the stock at 157, there's $17 of intrinsic value. The difference between 140 and 157 would mean that option is worth about $1,700. Something the options trader paid $18.35 for is worth $1,700. It went up, but it didn't go up enough to hit break-even point and become profitable. But it's a $135 loss, down 7.4% from the risk. Miss Extra Leverage, the 2 at-the-money options, her contracts are in the money, so there's $2 of intrinsic value. She has 2 of those contracts. That's why the market value is $400. But she's lost $1,190. She's lost 75%. Again, her break-even point was higher, and it didn't reach that break-even point, so she suffered a bigger loss. And, of course, if we take a look at Mr. Go Big, Okay, now this extra leverage can liquidate or exercise. A question came up: when would you exercise? Well, think about this extra leverage in this case. Her options are in the money at expiration, meaning there is some intrinsic value. So she says, man, the stock's moving in the right direction. There just isn't enough time for it to do what it needs to do. So she says, I need more time. Well, one, she could roll the option out. She could basically sell this one while simultaneously buying another one, or she can exercise. She can do that on etrade.com and exercise and say, I'm going to turn my 2 call options into 200 shares, and I'm going to buy 200 shares. I've got the right to buy them at the strike price, which is 155. So if she's got the ability to buy 200 shares at 155, she can exercise her right. And all you're really doing is becoming a shareholder. That's all you're doing. So she could liquidate, she could sell the option, or she could convert the option to shares. And then once she's got shares, there's no time limit. But the question here is, would she want to change her risk? Because right now, if she just liquidates, then she's just done with the trade. Yeah, she's lost 1,190. But if she converts the shares over, now she's expanding her risk. What are we looking at here? $31,000. So now the scenario changes from most you could lose is 1,590 to, hey, most you could lose is 31,000 because you just bought 200 shares at the price of 155. Granted, it's worth more than 31,000, but now that you own shares, you've changed your entire risk exposure. And then, there's really nothing to talk about with Mr. Go Big's contracts, even though he's got 4 of them. They're out the money at expiration. Stock's at 157. He needed to get to 170 for any intrinsic value. And then he needed to go up to 172.15 to break even. And he's nowhere near. So, boom, he loses again. He loses the $860. That's scenario 4. Let's go ahead and take sort of the other downside scenarios here. Scenario 5, stock falls to 140. Ouch. Wow, 140, 150 to 140, boom, that's painful. Well, let's talk about the pain. The stock trader's down about 10%. Okay, I get it. The shares are worth 14,000. The stock trader's down 1,407, a loss of 9.1%. But here's what I would point out. The stock is worth 14,000, but how much risk is still on the table? 14,000. That stock could go to 13,000 and 10,000, 11,000, 9,000. It could keep going down, right? There's still a lot of risk on the table. The options trader, the market value is 0. So the options trader lost 100%, 1,835. But the pain is over. You're done. Your risk is finished. The trade went as bad as it could go. And what I like to suggest is that the person that bought, the options trader that bought that, can afford to lose $1,835. You're speculating. But the person the stock trader that put $14,000 in there probably can't afford to. Losing that $14,000 probably has repercussions like, well, looks like I'm going to have to borrow money to do this, or can't take that vacation, or can't pay off the mortgage, or, hey, kids are going to have to work at school, something. There's kind of a bigger repercussion. What the money you're using for your options generally needs to be money that you can suffer a loss. But you don't have to, right? Remember, as the stock is going down, so the 140 strike is worthless, but did the options trader close? Remember my scenario where 10 days the stock had gone up and you're making money? Do you want to close it and just, hey, you're winning. You want to take your ball and go home since you're winning the game? Even though we're only in the 3rd inning, whoops, sunsetting, I'm winning, looks like I win the game, right? You could do that. Same way. The options trader, as the stock was going down, the options trader was seeing the losses build. You can stop those losses with the push of a button and close it out, assuming the stock went down gradually and didn't do some sort of, big gap to the downside. But I'm suggesting here that it kind of, bled down. Did the options trader close out? right? Did the stock trader close out? How about Ms. Extra Leverage? As the writing became more clear on the wall, that the momentum was changing from upside moves, bullishness, to downside momentum, bearishness, did you take action? Did you close it? Did you close your loss out at something greater than 100%? What did you do? I think with the options trader and this extra leverage, the style of their trading would probably indicate there was a point in which they said, I'm out. We've got a way in Power E-Trade where you can set an exit plan, where you can say, hey, if I double my money on this option, take the money and run. But if I've lost half, take the kick to the gut and get out. You can create this it's called a one cancels the other bracket order. We call it exit plan. And you can adjust those percentages. Hey, if I can make 60% to the upside or lose 30% to the downside, get me out. You can automate these kinds of exits if you want. Now, the nature of Mr. Go Big, come on, there's no doubt. The nature of that trade was that he held until the end, went down fighting. It's just like the lotteries that we've had recently. And my dad goes, oh, I'm going to go down and spend $20. Dad, really? You're going to go spend $20 on a lottery ticket? Man, if you win, that'd be horrible. But anyway, that's a completely different discussion. So anyway, my point with slide 5 is that as the writing becomes apparent on the wall, options are liquid. You don't need to suffer that loss. The problem sometimes with stock traders is they go, look, it's a good company. I got all the time in the world. It'll come back. It just takes time, right? Maybe, maybe not, but there's still a lot of risk on the table. All right, scenario 6. So remember, they're liquid. Stock falls to 147 in the first 10 days. Hopefully I've planted that seed. You look at this now, if you can see on my chart, and I don't have really the best way to highlight this, but see, we step up and then we step down a little, then we step up more, and now we're stepping down some. At 147, me as a trader, I might say, things are not, the chart is starting to look differently than it has in the past. We've stepped down to maybe a support level where buyers will come in. If those buyers come in the market, we should not go any lower. Come on, buyers, come in. But if the buyers don't come in the market, then it's going to go lower. And if it goes lower, I'll be losing more money. Doesn't matter which position I'm in. I'm going to get out if we go much lower. So you could automate it here. But what I want to show you is that the stock trader is down about 5% at this point in time. So she can do whatever he or she wants as far as managing the position. Same way with the options trader. You would probably close out if it goes much lower. If you close out now, then you can salvage, that is an intentional word, salvage $1,055 of the $1,835 that you have put at risk. Yes, you're going to take a $780 loss, and yes, your spouse is going to give you that look, right? Or you're going to have to cancel that dinner, that trip, whatever you'd planned to take that loss. Or you can stay in. It's entirely up to you in this case. And the reason I say you can stay in is that you've already defined how much money you can lose, $1,835. Maybe you're okay with that. Hey, that just means it's $1,835. It doesn't mean we don't put food on the table. That doesn't mean we don't, fuel up our vehicle. That doesn't mean the kids don't go to college. It's $1,835. Whereas with the stock shares, I'd say you still got $14,700 at risk. Think about how much you're willing to give up. It's a lot more capital. So this extra leverage might close. Remember, she's a little bit more speculative. She wanted more leverage. So she might close. She might do nothing. She might say, you know what? We're at support. I feel confident those buyers are coming in, and we're just going to turn right around and go back up again. We're going to get back up to 150, 155. So I may double down and buy even more. Now, Mr. Go Big, of course, says, you only live once. Money ride. Leave it. Leave the cash on the table. Let's see what happens next. I doubt there's any management going on when you are going big or going home, when that's your approach. All right. those are our potential outcomes. I know that I am right at the conclusion here. So I said I didn't think I was going to have time. I don't. Let's do this, though. Let's go ahead and I'll hit you with the takeaways real quick. Buying calls provide traders an additional way to utilize leverage and speculate on an upside directional move. Sean, what's the best one? What's the best option to me to buy? The only way to answer that is to know where the stock is going to be, right? If I'd said, I can tell you right now, 99.9% confidence that stock's going to be at 180. Come on, you know the answer there. But I say, realistically, if I take what the stock has done over the past 90 days and I extrapolate to where it's going to be at the same rate of growth in 90 days, it should be about here. Then work backwards. Figure out what the best strategy is based on your prediction. Okay. And then, of course, options are not suitable. I hope you're understanding and you're going to stick with us the rest of the day. I get it. If you're like, too much, no mas, I understand that too. There's different risks in buying stocks. You've got time decay, unexpected changes in volatility. There's some fees, and then overall, they're simply more complex. There has to be some advantages in your mind or in reality for you to want to move forward with these. To trade options, you do need to get the option approval. We talked about that earlier. etrade.com/options on each of the accounts that you want to do this with. And then, of course, this is being recorded for all of our offerings, etrade.com/events to continue. And then I will go to wrap it up here since I didn't leave time for questions. But how are you feeling? Remember, we're 2 sessions through the day. We've got Ken coming on from the Options Industry Council, and he's going to go through a covered call being on the other side, more of an income approach to it. But how are you feeling about the concept of buying calls? Let us know. And then, of course, we've got the survey. Thank you. We had hundreds and hundreds of people fill out the survey. If you wouldn't mind doing the same, letting us know how this session, kind of filled that need, hopefully filled the void of what comes next. This is kind of what comes next. And then we've got a short break here. Let me look at my time. Short break here, 8 minutes. We've got Ken Keating coming on from the Options Industry Council, come with a different strategy, different approach. And then Rick's going to come on and talk about puts. And then Dave and I are going to start doing some demos on how to execute trades. I'll even do some live trades because I set my session up to still be in the market. Guys, if there's nothing else that needs to be covered, then I will go ahead and go to the thank you slide and give everybody a quick opportunity to do what you need to do. And then we'll be back reconvening in 8 minutes for Ken's discussion on covered calls. Thanks, everybody. Talk to you soon. Bye-bye.